Good afternoon to all of you. This is Ranjan from smartfinancing.com. This is our website, smartfinancing.com. If you go to our product link, you will get that we are into the academic services. Also, we have some fantastic software for option analysis, equity analysis and all. And these softwares are depend on various unique concept of WT GAN, volatility. So this particular presentation, I am going to describe one very interesting strategies in the Nifty. So I will request all of you, once you see this strategy, its composition, it is having 3 legs, couple of buys and sells. So just that strike and the premiums, whenever you are seeing this video and you take a note of that and keep it with you. So this strategy, whenever we are initiating, Nifty is at 24,186. So 24,186, 25,186, not 24, 25,186. This is the Nifty is trading Nifty spot. And here what we are getting here, if it is 25,186, then this August with respect to spot, this is spot Nifty. However, options will take the future as a reference till the last day of expiry. On day of expiry only they will flip the side or they will follow the spot as their master, or valuation will happen as per the spot. However, this particular setup what you are seeing here, it is just look like a 3-leg strategy, but it has an interesting thing associated. What is the interesting thing in this? While forming this strategy, very carefully listen to this. While forming this strategy, or now if I am forming, the net delta of this strategy is negative. Net delta. So delta of this called put, again put, if I add together, it is negative. However, once the price will go moving up and just come near to 25,500, near to 25,500, without doing anything, this delta will become positive. Quite interesting. Without doing any of your adjustment, the strategy's delta flips to negative to positive. So it has a smaller risk. It has a greater reward also. It is open-ended strategy. So here we will discuss about that, what happens in this strategy. So as I said to you, it is 25,186 is the Nifty quoting now, and when we are recording this event, and this is also, this will keep on changing 182, 183, 186 like this way. This is the level. So when you are seeing the video, Nifty will be different also. So with respect to this spot 25,186, this 25,500 call option of August monthly expiry, this is OTM. Similarly, the put option also OTM. So 25,000 put also OTM. So here there is a difference of 40 rupees or 40 points in the premium. So you are, that is based on the closeness of that strike with respect to the spot. This is that premium or discount is big there. So there is a 40 points of deviation here. But here I am adding one more put options by, that is September, not August. You must ask me why not August, why September? If I add August, the flipping of that delta will not happen. The delta will not flip from negative to positive if I add here the August one. The reason is, so this particular option currently it is ITM, in the money with respect to the spot, but it has double the lifespan of expiry. So this particular option having some near to 25 days or near to 27 days extra life to expire. This extra life of 27 days is very vital for us, because this extra life will result lesser theta decay in these options. However, these two call option and put option having same expiry, so their theta decays will be relatively same, and they are in the same month, so they will have the similar kind of behavior. So this particular strategy required this much of money for the implementation. So here what I am doing here, relatively whenever we are initiating this strategy, the delta we are keeping at 30%. So means it is negative 30%. Once the trend is up, it will flip from negative to positive 30%. So this is what we want. It is again, it is an open-ended strategy for the uptrend, and it is a close-ended strategy towards the downtrend. Close-ended means profits are restricted, it may not move above. So if you compare these two things here, so here the put option sale and this thing, so 8 and 4 2s are 2, so 280 rupees debit is happening by this spread of a put options, only put option spread, this one. So you have 90, so 100, and here 300, 218 rupees as a reward, 280 rupees, 82 rupees as a risk. However, this risk will not trigger because of the life of this option is having 27 days extra life. So here coming to the call option, so call options will have a 301 rupee complete risk. So you are, if the Nifty fall to 24,500, so then you have, currently you are at 25,180. So this is what we have seen. So here, if it is corrects badly, then you have win risk of 218. You have to lose 301. So you can say, so 81 to 82 rupees of losses into lot size of 75. That is your losses. In spite of having a negative delta, in spite of having a fall, you are still losing. However, if it is goes up, you are in uptrend, it is open-ended. Say if it is going to 25,600, 700, 800, 26,000. So what happens? 282 is lost. However, remaining things is profit. However, the theta decay in the September will be slower. So your losses, projected losses will be lesser. Profits will be more. So here, this arrangement of the things when to take, whenever there is a prolonged correction of 5-10 days happen, then after, if you wish to initiate, you wish to buy a call option instead of buying a call option, reduce the cost of buying of the call option by this way. However, be very careful in choosing these strikes. I have taken the same strike, call option and put option. What will be the ideal time to book the profit? The moment spot touches 25.5. That is the ideal time you should book profit in this particular strategy. What is the ideal time to book losses? 24,500. Imagine you did not get in the first attempt, you did not get the success, and it has corrected to 24,500. So you can book out of 82, you would have got some 40, 50, 60 as a losses, you should have come out. Then with respect to 24,500, 24,000, you can form another combination. So how long this market will fall? Say every 500 point of correction, you are trailing this particular strategy, and this way you continue, and one point of time when there is a great rally, your profits will be phenomenal. So what is the beauty on this strategy? While initiating, your delta is negative. Theta is almost 0 or positive negative 5 rupees. Theta is negative 5 rupees or 0. However, if the trend is up, then this delta flips from negative to positive, having or without putting any effort or any other adjustment. So that is the beauty of this strategy. I will request all of you, please note it down, do a paper trade, observe it for a couple of months, then you can implement this kind of strategy based on the trend analysis. Same time, I am saying that how you should learn this kind of strategies, because nowadays lot of bad news is being spread that nobody makes money in the options, because option is not a trading instrument, it is a hedging instrument, it is an advanced instrument. Everybody should learn it, then only you can. We have a 35 hours course. It is a very old course we have designed years back. It has basics, then you have certain strategies in this particular way, the way I have told you. So here one put spread only we are forming, but we are buying September and selling August put. So this makes lot of changes. It alters the theta, it alters the delta, it alters many things. So these kind of strategies are known as hybrid strategies. So this kind of strategies you will learn in this particular course. And we do have very fantastic softwares to analyze the option instrument, to get its values, its Greek calculations and other things in a proper way. So many software lack the lacuna of calculating the Greeks of options. Suppose if you want to calculate the Greeks of the options, you must know that perfectly it should be calculated. Otherwise, it will give you a great disaster result. So if the Greeks are not calculated properly, so our software smart analytic tool gives a perfect calculation of the Greeks. Suppose if I am going for now 25,800, 25,000, say 200 or 150, call option calculates this. So this Greek estimation must be proper. Otherwise, what happens, any strategy you implement, it will have a disastrous result. And one more thing is very important in strategy. Strategy is not a game that anything you can buy, sell, and it form a strategy. No, strategy must have an objective. How much theta you want to keep, how much delta you want to keep, how much risk you want to manage. If you make your risk as 0, reward also will become 0. So how much risk you are going to keep? Out of this, I want to invest 300 rupees in this call option. However, I want to carry only 80 rupees risk in this purchase. I want that my 210 rupees should not be a risk. It should give me from some other sources. So these particular things is very important in option strategy. Combinations may be different. However, objectives must be defined before entering. Before entering the trade, your objectives must be defined. You must know if it goes wrong, where I should come out. If it goes in favor of me, where I should come out. What is the current standing on option Greeks, delta, theta, vega, omega, and at the moment of my profit, what should be their role? When I am incurring losses, what should be there? It must be simple, it must be understood, it must be scalable. So all these things are very important to become an option strategy. So if you are prepared for that, then you take up this course, learn it, and before taking up that course and learning, you must track this strategy for 1 month. Then you decide whether money can be made in the option strategy or not. This we have been telling from the 2005 onwards, that you need to prepare yourself. Nobody can earn money for you. You need to earn your money. For that, like your basic education or professional education, you have to educate yourself. Then only you can able to learn. So follow this strategy and give your feedback. If you have any query related to our product and services, feel free to call in these numbers. Thank you very much. Thank you for your time.